How do Islamic mortgages work with Mudarabah? Have you ever wondered how Islamic mortgages function, particularly with the concept of Mudarabah? Let's break it down in a simple way. In Islamic finance, Mudarabah is a partnership where one party provides the capital while the other contributes their effort. In this case, the financier, known as Rab al-Mal, supplies the funds to buy a home, while the customer, referred to as Mudarab, manages the property or the repayment process. The beauty of Mudarabah lies in its profit-sharing model. When the property generates income, the profits are shared between the financier and the customer based on a pre-agreed ratio. If there are losses, the financier bears them unless the customer acts negligently or violates the contract terms. This risk-sharing approach aligns with Islamic principles that prohibit interest, known as riba. Now, how does this work in practice? The financier uses the capital to purchase the property. Instead of paying interest, the customer makes payments based on the profits generated from the property. These profit payments are agreed upon beforehand, but remember, they depend on the actual success of the investment. This is a significant difference from conventional mortgages, which typically involve fixed or variable interest rates. In some cases, Mudarabah can be combined with other Islamic finance contracts, like Musharakah, which means joint ownership. For instance, the bank and the buyer might co-own the property. The buyer gradually buys out the bank's share while paying rent for the portion still owned by the bank. This method ensures that payments reflected actual ownership and usage, steering clear of interest-based lending. To summarize how Islamic mortgages work with Mudarabah, first, the financier provides the capital to buy the home. Second, the customer manages or uses the property, contributing their effort. Third, profits from the property are shared according to the contract. Fourth, any losses are the financier's responsibility unless caused by customer negligence. Fifth, payments are structured as profit sharing instead of interest. Lastly, ownership arrangements may involve joint ownership to comply with Islamic law. This structure not only adheres to Islamic finance rules, but also promotes fairness and ethical investment in home financing. Understanding Mudarabah can help you navigate the world of Islamic mortgages effectively.